Hi, I'm Mark Persano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So on today's Econ show, just because it's late and we wanted to make sure that we covered inflation, and that's really what we're getting a lot of the questions on, we're just going to do two segments just on the US. We're going to do one that's looking at the pace of inflation. Remember, we've been talking about stagflation, why that's coming through, and here it's starting to peak. And then we're going to also look at how is this impacting the consumer and how that pain still resides within the system. So just jumping right in, here you can see what the CPI was. It obviously eased to 8.5% year on year versus the estimate of 8.7%. The core was at 5.9 versus the estimate of 6.1. And again, it was 5.9 prior. So realistically, it's just the rate of change. Like everyone keeps saying, well, there was no inflation this month. It's like, no, the rate of change stopped. But you have to appreciate what part of that stopped, because it wasn't universal. It wasn't like everything deflated. It was driven by one thing and one thing only. It was energy. So when you look at all other things, prices continue to go up. And as we know, energy is lumpy. That's why we bucket it as flexible, not sticky, because when you look at sticky inflation, it continued to go higher. So there is a lot of noise within this that we really want to go through to really see what is the nuts and bolts of it and how are things adjusted. So headline, CPI was unchanged, so it was flat versus the estimate of 0.2. So but core was up 0.3 versus the estimate of 0.5. So again, even when you take away energy and you take away food, core was still up. And that's what yes, it wasn't up as much as estimates, but it was still higher. So the rate of change continued to go up for core. The headline number was flat, so the rate of change just stayed the same. But even if we had no change from this point forward, inflation would still be up over 6% year on year. So it's not like we're getting this massive deflationary move where everybody's going to benefit. It's just that we stopped going higher. We're not going higher at a fast rate. We're starting to level off. But that's usually what happens, which is why when we talk about this leveling off, that's where we see some of these concerns as we go forward. So to put it into perspective, core CPI was expected at 0.5, came in at 0.3. The decomposition of it, when you look at what drove the deflation or what drove it to miss, was airlines. So airline fares were down. You had lodging, which was down. You had car and truck rentals, that was down. And when you look at rent and OER, that was much higher. And when you look at other stuff, that was higher. So the things I pay every month, like how often do people fly on a plane, but how often do you pay rent? How often do you pay your owner's equivalent rent, which is your mortgage and taxes and insurance? How often do you buy things? Like when you look at what went down versus where things are, it's just the stuff that causes the most pain to a consumer that is paying it month in, month out, that continued to go up. So again, looking at just the composite overall, when you look at it, was energy. But energy is a very catch-all because, gasoline was down. We know that. But where is electricity prices? Where are they going? Where's natural gas? Where is it going? Where is heating oil? Where is that going to? So when you look at some of these key pieces, as we come out of as we go into shoulder season, you'll get some of this reprieve. But when we look at electricity prices, when we look at natural gas pricing now at $8.72 heading into shoulder season, what is it going to look like during winter when we look at natural gas for heating, when we look at heating oil, when we look at some of these electricity pieces? Again, those are things that are not going away. If anything, we think it's going to become a bigger hindrance, and it's actually going to start to bridge some of that where, yes, gasoline will keep coming down, but diesel's going to stay sticky because road diesel and heating oil compete against each other. They're molecularly the same. So again, that's going to provide some of that backdrop when we talk about some of those inflationary pressures. And this just puts it into perspective where if you have 0% CPI, that gets you to 5.43%. When you look at just a 0.2% CPI, You end the year at 6.7, and then a 0.4% CPI, again, essentially right around where we've been sitting. We're going to close the year at 7.98%. So even if you get this huge adjustment in inflation going away, which we know it won't, this is, again, you're still going to be at a very painful point, and you're not getting this nice little backdrop. Instead, of what we've been saying is you're going to get a lot of staying power at the top. Food inflation is up again. We'll talk about that in a minute. Housing inflation is up again. Stuff continues to go up, which is some of that backdrop. And yes, gasoline is going to be lumpy. Some months it will be up, some months it will be down. And this puts it into perspective. When you look at June was white hot for gasoline, motor fuel, energy commodities. Now it's cold. But again, it could easily just adjust once more. And it's not to say that we think we're going to continue to see these massive swings, but it'll swing. It'll move. We'll get another benefit as we go into September when you have winter grade instead of summer grade gasoline. But what is going to happen as people start turning the heat on? What happens if we have a cold winter? That's where those energy commodities and energy consumption continues to adjust. But when you look at June and July, what continued to stay hot? Food at home, food away from home. Those continue to go up at over 2%. So again, you're not seeing some of the key pieces. Yes, I can drive less, but am I going to eat less? No, you'll eat differently. But all things food are going up, which is, again, some of that inflationary pressure keeping us and moving us into that stagflationary backdrop. The breakdown of CPI by components, here's where you get an idea of just that shift. But again, when you look at food, it's continuing to go up. When you look at energy, that was the drop. When you look at core goods, continuing to go up. When you look at core services, actually went up. So again, it just goes to show some of the different backdrops. And I think this is important. Rent of primary residence up 0.7, owner's equivalent rent up 0.6. Yes, it wasn't the peak from last month, but it's still going up. It's still at this elevated level. And this is a huge pain point of things that we continue to see in general. So now this is, as everyone knows, this is one of my favorite dashboards. So core CPI, 5.9%, but look at the Cleveland median CPI at 6.3 and the trim mean CPI at 7%. So I've had questions asked about, well, what gives you some confidence that you're going to continue to see this upward pressure? And those two key pieces, because if you look at July of 21, core CPI was at 4.2. You had Cleveland mean at 2.3. You had Cleveland trimmed at 3.0. So core was higher, and core is normally higher than one of these pieces. But the fact that the median and trimmed are elevated, you still have a pull up on that inflation. You're getting some of the push when you look at food, when you look at rent, but the pull is going to be on those other pieces that are trimmed, the other goods that are weighted a bit heavier in the medium and trim side, which gives you an idea of where this is going. The sticky CPI up at 5.8%. Again, that is where we're seeing some of this breakdown where, yes, flexible came down, but sticky CPI actually went up. And I think that's going to be a very important piece when you look at the sticky inflation, when you look at the average difference versus core, when you look at the stats over the month. Sticky is still moving in the wrong direction. And given the trim mean, given the median CPI, it's going to continue to move up, which is going to keep core CPI bid elevated and moving in the wrong direction. And now when you look at just putting into perspective of where it is versus previous. So you're looking at stickier core measures of inflation that they're still running white hot. Trim mean CPI jumped to a new record year-on-year rate in July, but did ease month over month, but it went to a new record. And again, it's flatlining. But when you look throughout history, it's the highest it's ever been. And that's where we continue to see some of this pressure. Now, just putting it into a different chart with the print in July slowest since May 2020, but it's a different story for orange, for the core, which is the orange one, but it's still a welcome move. But again, not moving all that much. Grocery shopping trends continue to adjust. So when you look at buy organic products, buy premium products, it's no surprise to anyone, it's down. So this is what I'm saying, where people will eat differently. You still need to eat. You're just not going to pay up for organic. You're not going to buy a premium product. You're going to look for pricing discounts. You're going to look for some of those shifts. So when you look in July, you're continuing to see, again, that pivot where people are just trying to buy something a bit differently, trying to save some of that money. Revolving credit search continued to be active in conjunction with a significant increase in debt. Consumer search activity about revolving credit has been consistently high since mid-May, as again, they're trying to manage what is their spending going to be. Consumer credit month over month was expected to be at 27, came in at a whopping 40 billion. So when you look at it overall, just exploding to new highs. Securitized. So when you look at it in general, we've now blown straight through the pre-COVID because you had people paying off their credit cards, paying off their debt, and now we're right back to where we are as people continue to live off of credit, which is why we see a lot of pressure and why consumption is going to continue to move on the downside, especially as when you look at single most important problems for small businesses. You can see inflation is catching even more of that because the quality of labor issues are dwindling. But inflation, again, is continuing to be the highest driver. Inflation remains the decisive issue for small businesses, with 37% now saying it's their most important problem, and it's the highest since 1979. Just to put into perspective where that sits. Small business, some of the other adjustments that we've seen, labor indicators softening but not falling. And that's where, when you look at the NFP and where we are right now, you're starting to get some of those slowdowns. Hiring plans are dwindling. They're starting to come down, still elevated, but again, slowing, which is why when we look at a lot of the Fed data, the regional data, you're seeing things in contraction. The NFP was actually the only thing that was positive because the challenger job cuts was up. The at-home survey, that actually showed a decline, which is how they come up with some of the other data points, which is why there was that disconnect between NFP and other, and then every single Fed employment index is also firmly negative and in contraction, but not slightly in contraction, like 49, 49.5. I mean, we're talking 46 and below because things are really slowing as CapEx plans are also dwindling. Small business optimism index bounced slightly in July to 89.9 versus 89.5 of the estimate. Outlook moved up from 61% to 52%, but is down sharply from the peak. Plans for higher compensation and raising prices also dipped alongside a dip in CapEx expectations. So again, your things aren't going to hell in a handbasket, which is where you're starting to see some of this flatlining, but you can still see that there's a lot of concern. And if they have concern, what are they not going to do? They're not going to hire or spend. And that, again, is going to just keep that pressure on the economy. The decisive rollover in percentage of small businesses seeing higher prices is good. Very few are seeing poor sales as their most important problem, which also is a positive. But those higher prices starting to pivot. You can see it's still elevated, but one of the things that we had said is it's going to fall, but then find that plateau when you're looking at the different costs coming through and as wages continue to be that overhang. Now, sales expectations, when you look at where things are going in general, you can see that the sales expectations get worse. So right now, they're not seeing the issue, but they see it coming based on new orders, based on all of those leading indicators we've been discussing, which is why we do think that the CapEx plans get worse. Some of that continues to move lower, which is going to make, again, that sales expectation a bigger overhang, which again is also pulling down CapEx plans. And all of this is, again, that's showing that slowdown in general on the on the U.S. economic front, but it has steep knock-on effects. U.S. average weekly earnings, slight move up in real average weekly earnings in July, but still in negative territory. And that's because, again, inflation slowed. So you had the pace of inflation slowing. You're still negative. You're still at negative 3.6, but you're not at negative 4.1. So again, there's still pain. It's just a little less pain. But if you notice that small percentage change in your spending habits, more power to you. I know that things continue to go up. So it's still an underlying problem in general. There's a serious convergence continues as core goods price ease and core service prices move higher. And this is, again, just showing what we've been talking about. They're going to converge together, and we're going to continue to see that happen. And we do believe that services will overtake goods, not because one's going to gap up or gap down. It's just they're going to keep moving in that direction. Now, U.S. inventory to sales ratio for furniture surged in June, given wholesale sales for a sector fell by 2.9% and stockpiles rose by 2.6%. So I know I had friends that moved in 2020 and they weren't getting furniture for 6, 8, 12 months. Now's a good time to go see if you can get a deal, because you're getting an idea of how, again, that this is that bullwhip impact that you're gonna hit, and that will bring some of the prices down. That will increase sales, but the question is going to be by how much, because there is a sunk cost, and this is why companies can get concerned about over ordering, because you're going to lock in these prices. So then your inventory is going to be costly. And how much of that cost are you going to be able to pass through, especially if your competitors are starting to issue discounts? The Federal Reserve trim mean, again, the trim mean gauge increased by 0.4% in July versus 0.8% increase in June. The jump still ranks among the largest going back in history, but it's an ease. But again, you can still see you're still clustered in a very troubling spot, which again is why I see a lot of that pain, a lot of those pressures continuing in the region. Now, the top 5 subcomponent contributors to PPI. So now we're pivoting to PPI for a moment. Another, again, tailwind. When you look at it in general, core PPI was expected at 0.4, came in at 0.2. When you look at the headline, it was down, but it was finished consumer energy goods. So it was energy, again, that was the driver to the downside, where we still had an increase in trade of personal consumption goods. You still had an increase in goods for exports, excluding foods and energy. So you're still getting some of that movement and consumer foods as well. So again, there's still that pressure, and it's going to be lumpy. And we've said it from the beginning, it's going to be lumpy, but we're seeing, again, some of that upward pressure. But the core side, while slowing, is still showing that upward path. U.S. PPI final demand came in at 9.8 versus the estimate of 10.4. Ex-food and energy came in at 7.6 versus 7.7 on the estimate side. PPI as an overhaul came in at negative 0.5 versus the estimate of positive 0.2, while core remained elevated. So again, you're starting to crest, but that's where we've been talking about some of that back and forth, especially when you look at the issues coming from Europe, the issues that are happening in China. And we'll talk about this next week, but Chinese exports were very strong, which they should be on the catch up, but imports were terrible. And remember, imports are a expectation of future export, are indicative of future exports, as well as local demand, which continues to be weak. And that's where we see a lot of issues in China. But they also had some of their stickiness in CPI and PPI, which is one of the things that we're going to import. And that's why when you look at the one key rub in all of this, the PPI report in July was lack of uniform decline in freight costs. Deep sea, which is orange, rail, and purple costs moved higher, while freight, blue, and air transportation, white, ticked down. Price levels for all components remain very high. And you're getting an idea. It's starting, like you're seeing pieces of it, but there's other places that are starting to go back up. And how much of this is diesel? How much of this is that front end loaded, which again is going to continue to move through and keep us capped at that elevated level, more on the stagflation side. U.S. PPI final demand services was up 0.1. So service component of July PPI didn't go negative like goods, but was actually up 0.1% monthly gain. Was one of the softest readings since the start of 2021, but still elevated, while significant drop in PPI goods, which was down negative 1.8%. But remember that huge build in furniture. Services is where we've been talking about that pressure, while you're going to see that drop in goods. But the amount that services went up and how weighted the U.S. economy is to services is going to keep things very elevated. then the decomposition, when you look forward on PCE inflation, it's still going to be positive because you still have contributions from components covered by CPI. You still have energy dragging you down. So when you look at the core PCE, you can see financial services, charges and fees are down, airlines down, but other things, goods, other things that we use are still going to be up. So we're still going to have a positive PCE number, which is going to show that inflation is still sticking around. And again, energy prices changed from the month earlier down, but look at food prices. Food prices are still going up at over 1%. Select food categories, butter and margarine, 25%, flour, over 20%. Again, cereals, you're just getting an idea. Baby food at 15%. We're not getting this fix all. Instead, we're just getting it shifting where energy and gasoline aren't as much of an issue, but what about food? This is a huge issue that is not going away anytime soon. US PPI finished consumer foods year over year, the highest ever. 15.9%. So again, yes, one side is good. The other side continues to get much worse and will be fed down into the system. And the cost of living increase is larger for lower income households, which is, as we've known, inflation is a huge hit for the poorest countries, for the poorest person, because there's no alternative at a certain point. And you're seeing this hit at a huge level across the board, not just in the US. And this is going to be a huge problem that we're not going to see go away. So that's what we have on the inflation side. And again, this inflation is also going to get exported from, which is what the IMF is showing. But now we want to go a step further and look at what is happening directly to the consumer and if we're seeing any adjustments in that. And short answer is no.